Close your eyes and imagine this. You're 65 years old. Your alarm still rings at 6 a.m. Your back hurts. Your energy is gone. But instead of walking onto a beach, you're walking into work. Now here's the real question. Why is this future becoming more common when we've been promised retirement our entire lives? From childhood, we're told a simple story: work hard, save money, retire comfortably. But something doesn't add up, because despite decades of economic growth, technological progress, and record corporate profits, more people than ever are facing the possibility of working until they did. So what went wrong? Was it laziness, bad decisions? Or is there a hidden system quietly reshaping the future of retirement today? We're going to expose the uncomfortable truth, not with opinions, not with motivational talk, but with cause and effect, because retirement didn't disappear overnight. It was engineered, step by step, and it starts with a promise that was never designed to last. Retirement is not ancient. For most of human history, people worked until their bodies failed. The modern idea of retirement began in the late 1800s. In 1889, German Chancellor Otto von Bismarck introduced the world's first government pension system. But here's the detail most people never hear: the retirement age was set at 70 years old. At the time, average life expectancy was around 45, meaning most workers would never live long enough to collect benefits. It wasn't generosity, it was political strategy. The government gained worker loyalty without paying much out. This model was later copied by countries around the world, and in the 1930s, the United States launched Social Security during the Great Depression. The promise was simple: pay in while you work, get paid when you're old. It sounded fair, logical, secure, but hidden inside this system was a fatal flaw. Social Security is not a personal savings account. Your money isn't stored for you. It's immediately paid to current retirees, which means the entire system depends on future workers funding past workers, a pyramid structure. And like all pyramids, it only works if the base keeps growing. At first, it did. After World War II, something extraordinary happened. The middle class exploded. Factories boomed. Wages rose. Homes became affordable. One salary could support a family, a house, a car, and a retirement plan. Pensions were common. Companies promised workers lifetime income after retirement. It was called the golden age of retirement. But beneath the surface, the system was already cracking. Because this prosperity was built on rapid population growth, cheap energy, expanding global trade, and government debt, the baby boomer generation created a massive workforce paying into retirement systems. Everything looked stable, so governments made promises. Companies made promises, and people trusted those promises, but none of them planned for what came next. By the 1970s, the world changed. Inflation exploded. Oil shocks hit economies. Manufacturing jobs began moving overseas, and birth rates started falling. This created a dangerous shift: fewer young workers, more aging retirees. The worker-to-retiree ratio collapsed. In the 1950s, there were 16 workers supporting one retiree. Today, in many countries, that number is close to 2 to 1, and falling. That's not sustainable. At the same time, companies realized something: pensions were expensive, risky, and unpredictable, so they quietly replaced pensions with 401k plans and personal retirement accounts. This shift changed everything. Responsibility moved from employers to individuals. Risk moved from corporations to workers. If markets crashed, your problem. If inflation destroyed savings, your problem. If you lived longer than expected, your problem. Retirement was no longer guaranteed. It became a gamble, and most people didn't notice, because the system didn't collapse overnight. It eroded slowly. Fast forward to today, wages have barely kept up with inflation. Housing costs have exploded. Healthcare costs are rising faster than salaries. Education debt follows people into middle age, and savings rates are collapsing. People are not failing to retire because they're irresponsible. They're failing because the math no longer works. Let's look at the cause and effect chain. 1. Low wages mean less savings 2. High living costs eat disposable income 3. Inflation destroys purchasing power 4. Market volatility threatens retirement accounts 5. Longer life expectancy increases retirement costs. Every piece of the system pushes people further away from financial freedom. And the most dangerous part, most people don't realize how bad it is until their 40s or 50s. By then, time is already working against them. Governments saw this crisis coming. So what did they do? They didn't fix the system. They adjusted the definition of retirement. Retirement ages were quietly raised, benefits were reduced, eligibility became stricter, and politicians reframed the narrative. Now it's called active aging, extended careers, working longer by choice. But let's be honest, this isn't freedom, it's necessity. People aren't working longer because they love their jobs. They're working longer because they can't afford to stop. And this trend is accelerating. Gig work for seniors, part-time retirement, side hustles at 70. This is not an accident. It's the outcome of decades of policy decisions, corporate shifts, and economic pressure. And we're only at the beginning. So here's the mystery we need to answer next. If the system is clearly failing, why hasn't it been fixed? Why do the same mistakes repeat every generation? And who actually benefits from people working longer, retiring later, and staying financially dependent? Because the real story doesn't end here. The moment pensions were replaced with individual retirement accounts, the game changed. Before, companies carried the risk, governments absorbed shocks, workers had predictable income. After, you became the investor, the market became your pension, volatility became your future. 401ks and private retirement plans were sold as freedom, but what they really did was tie retirement to Wall Street performance. Let's break the cause and effect. You deposit money, gives banks invest, it gives markets fluctuate, gives your retirement rises or collapses. This means a market crash at age 30 is annoying, a market crash at age 60 is devastating. And guess what? Crashes are not rare. They are part of the system. 2000 dot-com bubble, 2008 financial crisis, 2020 pandemic crash, 2022 inflation-driven downturn. Every decade delivers a shock. And each one quietly erases years of retirement savings. Meanwhile, financial institutions still earn fees whether you win or lose. Your risk, their profit. Now let's talk about the enemy nobody feels immediately. Inflation. Inflation doesn't steal money loudly. It steals slowly. You save $100,000. Sounds impressive. But over 20 years of inflation, that money might lose half its purchasing power. That means your retirement number stays the same, but your lifestyle collapses. And here's the darker truth. Inflation is not just an accident. It is fueled by money printing, government debt, central bank policy, emergency stimulus. Every time new money is created, existing money becomes less valuable. So while wages struggle to keep up, assets like real estate, stocks, businesses rise rapidly. Who owns those assets? The wealthy. Who depends on cash savings and fixed income? The middle and working class. Inflation doesn't just raise prices, it transfers wealth upward. And it makes retirement harder with every passing year. Now combine inflation with debt, student loans, mortgages, credit cards, medical bills. Modern workers start adult life already behind. Instead of saving for retirement in their 20s, they're paying interest. Interest is money flowing out of your future. Every dollar spent on debt servicing is a dollar not invested. And here's the trap. Low wages force borrowing, gives borrowing increases expenses, gives higher expenses reduce savings, gives low savings require working. And longer gives working longer keeps people dependent on income. It's a loop, not a coincidence. Now, let's look at the real-world consequences. When people can't retire, society changes. You start seeing seniors competing with young workers for jobs, younger generations delayed in career growth, higher unemployment pressure, lower wage bargaining power. Why? Because when people can't afford to leave the workforce, labor supply increases. More workers Chasing fewer good jobs, this benefits employers, not workers. It also creates generational tension. Young people blame older workers for not retiring. Older workers blame young people for not working hard enough, but both are reacting to the same broken system. Divide the workers. Protect the structure. There is another effect nobody budgets for: mental exhaustion. When people realize retirement may never come, motivation collapses, hope shrinks, burnout becomes chronic. You don't just lose money, you lose time, energy, health, and ironically, health costs rise precisely when people need retirement the most, which pushes them even deeper into working longer. Another loop. Governments know there's a retirement crisis, so what have they done? Raise retirement age, reduce benefits, encourage personal responsibility, offer tax-advantaged accounts. But none of these address the core problem. The system requires infinite growth in a finite world. You cannot fix a structural math problem with motivational speeches. You cannot save your way out of wage stagnation and inflation. You cannot invest your way out of systemic instability. And yet, the same advice keeps repeating: save more, work harder, invest smarter, while ignoring housing affordability, healthcare, inflation, asset concentration, corporate profit extraction, government debt expansion. It's treating symptoms, not the disease. So now we arrive at the uncomfortable question: if leaders know retirement is collapsing, why don't they rebuild the system? Because collapse creates opportunity. When people are financially insecure, they accept lower wages, they take unstable jobs, they delay rest, they stay dependent. A population that cannot afford to stop working is highly controllable and highly profitable. That's the part nobody puts in policy speeches. If you zoom out far enough, you'll notice something disturbing. Every generation is told the same promise: this time the system is stable. And every generation eventually learns the truth: it isn't. In the 1970s, inflation destroyed savings. In the 2000s, market bubbles wiped out retirement accounts. In the 2020s, housing costs locked people out of ownership. Different decades, same pattern. The structure stays the same, only the crisis changes. And now, we are entering a period where multiple pressures are colliding at once: aging populations, rising government debt, persistent inflation, job automation, artificial intelligence disruption, global economic instability. This combination has never existed at this scale before, which means the retirement model built in the 1900s is being forced to operate in a completely different world, and it's failing today. Retirement is no longer a default outcome. It's becoming a privilege. Those who retire comfortably usually fall into three categories. 1. People who own appreciating assets. 2. People with strong business income. 3. People with high financial literacy early in life. Everyone else is relying on government programs under pressure, employer plans tied to market risk, savings eroded by inflation. That's not stability. That's uncertainty dressed as tradition. And here's the brutal truth: most people are still preparing for a retirement world that no longer exists. They plan for fixed retirement ages, guaranteed pensions, stable living costs, but the real future looks more like flexible work until later life, multiple income streams, asset ownership replacing salary dependence. This shift is already happening. It's just not being openly discussed. The biggest mistake people make is thinking retirement means stop working. That definition is outdated. In the modern world, retirement is better defined as freedom from forced labor, not quitting activity, not sitting idle, but reaching the point where you work because you choose to, not because you have to. This changes everything. Instead of chasing a magic age, the focus becomes building systems that produce income without daily labor. And this is where the real divide appears. Let's break down the three patterns shared by people who successfully avoid retirement dependence. Savings lose value to inflation. Assets grow with inflation. That's the difference. Assets include businesses, rental properties, dividend-producing investments, intellectual property, digital income streams. These generate cash flow, not just stored money. While most people store income, financially independent people convert income into machines that produce income. That is the fundamental shift. Traditional life advice says, get a stable job, but stability disappears when companies downsize, industries automate, economies slow, people who escape the system diversify income. Side businesses, freelancing, investments, online platforms, not because they love hustle culture, but because income diversity reduces risk. One failure doesn't end everything. This is the part schools rarely teach. Financial education, understanding, inflation mechanics, debt leverage, asset appreciation. Cash flow versus net worth, tax efficiency. Most people focus on earning, few focus on keeping and multiplying. But the system rewards those who understand its rules and punishes those who only follow instructions. In the coming decades, retirement will likely split into two realities. Group 1 works longer, depends on government support, faces rising living costs, delays rest. Group 2 builds assets early, creates flexible income, designs semi-retirement lifestyles, maintains autonomy. Not because they are smarter, but because they adapted earlier. And this gap is growing fast. This is the hardest message. There is no perfect government fix coming, no magical pension reform, no guaranteed retirement rescue. The system will continue adjusting, slowly, politically, inefficiently, which means individuals must adapt faster than institutions. That doesn't mean panic. It means awareness, because once you understand the structure, you can stop playing the game blindly. Let's summarize everything into 3 truths. 1. Retirement was designed for a different economy. The system you were taught to trust was built for a world that no longer exists. Planning your future using outdated rules guarantees disappointment. Inflation and instability make traditional saving strategies fragile. Ownership and cash flow matter more than account balances. True retirement isn't a number, it's freedom from forced work. And that freedom is built gradually, not magically at 65. Here's the uncomfortable warning. If you wait until the system collapses to react, you will be forced to adapt under pressure. The earlier you understand these patterns, the more options you have. Time is the most valuable asset, not money. If this video changed the way you see retirement, you're not alone. Millions of people are waking up to the reality that the old rules no longer work. But awareness without action is useless. So here's what to do next. Subscribe if you want deep breakdowns of money systems, inflation, and financial independence. Like this video so more people see what schools never taught. And comment, freedom, if you are ready to stop relying on broken systems and start building your own future. Because retirement isn't disappearing, it's evolving. And the question isn't whether the system will change, it's whether you'll change with it.